Hey guys, Whitney here. Welcome to another Tuesday session of Passive Investing Made Simple show. I'm going to give it just a couple minutes for everybody to file in the room. If you have not joined us for one of these live shows, welcome. This is a show where we talk about all things passive investing so you can go into your first or next investment with confidence. Be sure to check out passiveinvestingwithwhitney.com for all future masterclass sessions, as well as to see our open deals. And if you'd like to jump on the phone with me, you can see my schedule there as well. So today we're going to talk about understanding the offering memorandum. So today is going to be more of a presentation style of episode. So if you have any questions as we go through this particular topic, or about anything related to passive investing and what we do here, or like just on your own particular passive investing journey, make sure to find your Q&A box, drop in those questions. I'll answer what I can during today's masterclass session. Otherwise, for those of you who are here live, I'll stay on the webinar afterwards and we'll clean up all additional questions. All right, so let's dive in. For those of you who don't know me, I'm the Director of Investor Education here at passiveinvesting.com, but this is not what I went to school for to do. I actually started off in real estate in 2002, completely by accident, an accidental landlord. So I was a live-in flipper and house hacker and scaled a portfolio. Well, actually, I just had the started with the first house. My relationship fell apart with a significant other, and I was left with the house and all the utilities and mortgage and everything that came along with it. And I had to learn how to rehab the whole property myself, sold it for 11 months later. And, I was bitten by the real estate bug. And then, went on to figure out how many more projects like this could I do, live-in flipping and house hacking. And got really good at building up buckets of equity. My husband, who's pictured here, joined me along that journey as well. But we hit a couple of inflection points. One, we needed to figure out how to create passive income. And then two, we needed to figure out how to scale our properties in order to scale our unit count to take advantage of time. We only had so much time in the day. And at the time I was working a full-time job, taking care of family, taking care of our young child at home. And that's where we stumbled across passive private equity real estate investment. Now, that's probably why you're here, is to learn about the ins and outs of passive real estate investments. But to date, my husband and I, we've been able to scale up a portfolio of over 6,500 residential units, 2,200 self-storage units in partnership. But these are just numbers. What is more probably applicable to this situation and your situation is the result that we've gotten, which is 100% choice in how we spend our time. And I love spending my time here with you guys and educating you on the ins and outs of passive investing. Now, we can actually help you build a portfolio like this at passiveinvesting.com. To date, we have 1.3 billion assets under management, a 26.1% return, internal rate of return to our investors. And this is just over 27 months, average hold of 27 months. Now, today, as we work through all the ins and outs of the offering memorandum, nothing what I say here is financial advice, tax advice, legal advice. So make sure before you go into any passive investment, you are consulting with your financial, legal, and tax team. Very important that you have that team built. All right. So if you're new to the world of passive investing, you're probably going, what the heck is an offering memorandum? I don't even know what that is. Well, essentially, it's a document that states the objectives, the risk, and the terms of an investment, okay? And it can have several different sections, but typically it will have all the financials related to the investment, probably a trailing look back on the previous 3 months or 12 months of financials that are available. I'll also have what we call a pro forma, a forward-looking projection or a guesstimate of what things financials might look like. I'll have the biographies of the team members that are running the investment. It'll actually cover the business plan. Is it a development type of asset, buy and hold, something like that? That type of business plan will be in there. And there's much more that comes in there, but these are the main sections. Now, oftentimes you might hear this referred to as an investment summary. They're kind of interchangeable, but an offering memorandum is pretty standard language across all financial sectors. You might also hear called a prospectus. So if you're in stocks, bonds, and mutual funds, you probably every year you get a prospectus, which is essentially like the offering memorandum in this particular, or in private equity real estate. Oop, wrong direction, guys. Now, why is it important that you as an investor actually understand what the offering memorandum is? Okay, it's because it actually might be the only document that you get prior to placing a commitment into a passive real estate deal. So you need to get really good at reading this particular document. Now, for us, the way we structure our offering memorandums, we try to make it an all-in-one package for you to review with all of the pertinent details that you will need in order to understand, is this the right investment for me? So we'll give you an investment summary, we'll give you a profile of the property, multifamily, self-storage, car washes. We're going to give you that backwards looking financial analysis as well as the forward looking financial analysis. We're going to give you the market overview for that particular asset. And then we're also going to give you a look at our current portfolio and holdings, current exits, and track record, and our deliverables to our investors. Now, not all offering memorandums, I've been in the space for quite a while, I've made several private placement investments myself. Not all investments actually have all these sections. And so you want to make sure that you have the data in front of you. So if you're missing one of these sections, you're going to want to ask for it from the operator, okay? Because it's very important to have as much data in front of you as possible. Now, I want to go through some terminology, okay? This is not exhaustive, but I want to go through, concentrate, I should say, on how to read the financial section of an offering memorandum, all right? Because that's where most investors really hone in on, is the financial section of that particular document. Now remember, that document might be 40, 50 pages long, and the financial section might only be like somewhere between 3 to 5 pages of that section. Now, there are a couple other things that we'll pick apart in future masterclass sessions, which is how to read the lending section, how to read the market overview. But right now, I want to hone in on the financials. Because if you're new to private placement equity, you're looking at a whole different terminology set. Like, how do you evaluate if this deal is right for you from a return standpoint? Well, so let's kind of pick apart some of the terminology. Okay, now first, there is the actual returns. So what are the terms that we're looking for here? We're looking for the cash on cash numbers. We're looking for the internal rate of return. We might be looking for the annualized rate of return, and we're looking for the equity multiple. Okay, so those are the actual return numbers that will be projected. All right, the operator's best educated, planned guess for how the business plan might go. Now, here's the thing. There are also what we call performance hurdles, and oftentimes limited partners get the two intermixed. They actually they're evaluating a deal based off of return hurdles, not off the actual returns. All right, so terminology that indicates return hurdles would be like a preferred return. Okay, now guys, I totally get it. It says preferred return, that would be a return, right? No, not necessarily. That's actually a performance hurdle. And then an internal rate of return hurdle, or splits, the LPGP split. Now, how do we find these? How do we read them? Let's back it up. What do they even mean? Now, cash on cash, here's the formula for cash on cash. Quite simply, it's the annual dollar of income return divided by the total equity invested, okay? This yields the cash on cash. And for many cash flow investors, this is what you're looking for, right? You want to know how much cash flow is that asset throwing off for your investment today, and what will it grow to in the future? Okay, that's paying the bills today. All right, now for me, I love assets that throw off positive cash flow today and have a great business plan in place to grow that cash flow over time. All right, another return, hard return, is the internal rate of return. Now, guys, I'm going to give you a broad definition. And then as you can see, this is a calculus equation. So anytime you ask somebody, what is the internal rate of return? Most people are not going to be able to draw that for you on a whiteboard because it is a calculus equation. But an internal rate of return is the rate of return that would make the present value of future cash flows plus the final market value of an investment opportunity equal to the current market price of the investment or opportunity. All right. The higher a project's internal rate of return, this is the key part, the more desirable it is to undertake the project. All right, so what are we saying here? It's essentially the internal rate of return takes into account when you get your capital back. That's the difference between that and annualized rate of return. All right, and if the project timeline is longer, we would expect our internal rate of return to drop. If it's shorter and the returns are higher, we would expect the internal rate of return to go up. All right, let's see. Annualized rate of return. So as you can see, this is a less complicated equation. So this is the investor average return, and it can be including disposition or excluding disposition. So if it's excluding disposition, the annualized rate of return is the average return per year during the investment hold. Okay, it does not include return on capital. Now, if it includes distribution, it's the average rate of return per year, including profits from the sale. All right, so it's very important when you're looking at the returns, there'll be in the pro forma or in the offering memorandum, there'll be a little asterisk next to the annualized rate of return. And you want to actually go down to the bottom of the page and read what that asterisk means. Is it including sales proceeds or not including sales proceeds? And you'll see operators tag that different way. Now, a question came in, is there a guideline that you should be looking for an IRR? That IRR, the internal rate of return, that is going to be based on what asset class you're going into. Is it multifamily, self-storage, car washes? Is it going to be what market you're going into? Are you going into a major metropolitan service area? Is it going to be are you going to be going into a secondary market or a tertiary market? Okay, because that'll impact the cash flows of the asset, which is calculated into here, as you can see, CF, cash flows. And then also what type asset class is it? Is it a class A, class B, class C? Is it a more, is there a huge value add to the property? So all those factors get accounted in. Now, here's the thing. When you're targeting an internal rate of return, okay, you're going to want to this number will help you compare assets to asset, apples to apples, and figure out which is the best return for you. So if you're, if the hold is 5 years on a multifamily, and you're looking at several different multifamily deals, okay, now you can compare the internal rate of return across all those multifamily deals and get an understanding of which is going to have the higher internal rate of return. But now you need to understand what is the business risk in order to achieve that. All right. So, okay, now to answer the question more directly, multifamilies, you're probably on a class A asset right now, so hovering somewhere between 12 to 15%. Class B, value add strategy, maybe closer to 14 to 16%. And on a class C, you might be 15 to 18%. And I give you those ranges because, as you can see, sometimes taking on that additional risk doesn't actually get you a higher internal rate of return. All right, so you have to understand what kind of market you're in. All right, now the last actual true return we have is what we call the equity multiple. Okay, this is a very simple calculation. It's total cash distributions received from investment divided by the total equity invested. All right, essentially, it's how much money you as an investor could make on your initial investment. Now here, when you look at the visual on the right-hand side, the present value of the property, that would be all your cash flow plus your capital gains. Okay, that's what that would be, that top, that numerator, okay? All your cash flow across all the years of the hold, plus the gain that you can expect to receive upon sale, divided by your total capital invested. That would be your equity multiple. So if you're investing $100,000 into a project, and over 5 years, the project says it has a 2x equity multiple between cash flow and gains, you could expect, okay, the hypothesis is that you would come out with $200,000, the return of your initial investment plus the cash flow and the gains. You've doubled your investment. Now, here's the thing, equity multiple, okay, if you're going to compare that project to project, all the projects have to be the same timeline. With an IRR, they don't have to be the same timeline because that calculation takes into account time. All right, so just know which number you're using in order to compare project to project. All right, now I want to pick apart, the preferred return, and then we'll start looking at how can we extrapolate this data out of the offering memorandum. So the preferred return, oftentimes called the pref, it describes a claim on profits given to the preferred investors in a project. Okay, the preferred investors will be the first to receive up to a certain percentage of returns. So, if an investment says the pref is 7%, that means of cash flow and gains, the first 7% goes to the limited partner investors before the general partnership or other investor classes begin to share in those profits. Okay, so it's one kind of red flag. I had Dan Handford on here, one of our founding managing partners a couple months ago, is he will only invest in deals that have a pref or a pref with no GP catch-up. Now, we're not going to dive into a GP catch-up is today and what that means, but essentially you want to make sure you've got some sort of underwritten guarantee. I hate to use the word guarantee, but a designation of the first amount of profits to go to the limited partner investor. All right, let's see here. Okay, so when you have an offering memorandum, and I wanted to pick apart really quickly how can you pick apart the pref and the IRR hurdle. All right, because remember, these two are hurdles, they're not actually returns. Well, for us, we actually model it like this. So we'll show you the capital stack, but that really doesn't tell you anything. That just tells you the different layers of money into the project and who has ownership of what layer. Now, it's the partnership structure, and it's going to be delineated between cash flow and ownership. This is what you're looking for. So if you have a 7% preferred return to investors, okay, that first 7% off the top, that's the first hurdle for the general partnership to meet. Okay, once they've cleared that hurdle, now the general partnership gets to start sharing in profits and cash flow with the limited partner investor. 70% going to the limited partner, 30% going to the general partnership. Now, on the sales side or the membership equity, when the asset's sold, profits will go to the limited partner 70% until the limited partner, in this case, hits 13%. That's the next IRR hurdle. That's the next hurdle of performance for the general partnership to meet. And then the ownership structure splits to a different share. Instead of sharing 70-30, they now share 50-50. Okay, so I've done a couple of videos on capital stack and the waterfall. That's really what this is showing you here. Now, a lot of times when I'm on the phone with investors, they want to know the preferred return and the back end splits. But that's actually, if you want to understand what you're going to get paid, okay, what could you make on this project? This doesn't answer that question. What you are looking for is actually how to read the financial part of the investment. And this is where I encourage you to look for what we call a sensitivity analysis, okay? And not all operators actually put this into their projects. I don't understand why. It is probably the best table for an investor to truly understand what they could expect to make between cash flow and equity and everything on their projects. Now, we actually put in two tables. We'll show our investors the cash flow, but this is also when you're trying to figure out what are you going to make on the sale of the asset, it's actually the sensitivity analysis that's going to show you that. So on this particular project, let me kind of walk you through. On this particular project, we entered at a 4.2% cap rate. Now, if the market doesn't change or the 5-year hold of this project, the investor, upon sale, remember, we've got our little asterisks down here we got to pay attention to. Upon sale, they could expect to receive, if they invested $100,000, they could expect to receive $100,000, their proceeds back, plus an additional $75,731 of equity, making their internal rate of returns 16.7%. Okay, and then their equity multiple 2.06, because remember, they've been getting cash flow this whole entire time that they've got to add to this, right? Okay, now the average cash and cash would be 6% for this project. Annualized return, right, that includes the sales proceeds and the cash flow, would be 21.2. All right, so that's if the market didn't change. Now, you and I both know markets are always changing. Okay, they are getting hotter, right? The cap rate will go down, and maybe they're softening a little bit, and the cap rate goes higher, it expands. So this is why this table is so important, is because you want to actually see, kind of level set, fear set, what happens if the market gets softer. Okay, the cap rate continues to expand. Now you can see how our returns adjust. Okay, so our internal rate of return would go down to 12.2, equity multiple 1.7. All right, this is what I kind of, and this is 80 basis points or 0.8% over a 5-year hold. So this is where I really try to help investors kind of, gently nudge them. Look at the financials, look at the sensitivity analysis. And in what we would probably call a worst case scenario, where the market really leaps up very quickly overnight, we're still making money on this project. Okay, stronger returns. And this is just cash on cash, internal rate of return, and equity multiple. Guys, taxes are taken into account nowhere in any of these returns. Okay, so you still have all that benefit coming to you from taxes, the depreciation on the asset. All right, but for full color, we're probably going to land somewhere in here. So it's still very strong returns on the asset. Of course, we all want the cap rate to compress, continue going the other direction, and we're all smiling if the market continues to get better. All right, guys, that's what I have for you today, specifically over the offering memorandum. If you were joining on your favorite podcast player of choice, make sure to go look at the YouTube video, because there's a ton of information, and graphs in there. And if you're joining here live, don't go away. Make sure to go over to your Q&A box and